April 30th, 2024. And as you can see at the end of the month, a lot of times you just get a big move in either direction. And we did end up getting the surprise down. You can see we got, last couple bars today, a 30-point move, which is pretty big. But the bigger the time frame, the higher or the larger the move would be. So there's an end of day move, that'll generally be a little bit big, maybe something like this, an end of the week move, which might be a little bigger, an end of the month move, which might be even bigger, and an end of the year move, which might be even bigger. And if you have, let's say it was Friday today and you had a Friday as the last day of the month, there's an even more of an increased chance of a pretty strong move. We had a big leg one, leg two measured move today. Whenever you get a spike like this, odds are 60%. If you sell below bar 21, you put a stop way up here, and you put a limit order way down here, that you're gonna reach your limit order. But the more clear measured move today was this. We had leg one here, and then we started leg two down, and we got to leg two. So there was this, at the end of the day, but really today was a spike in channel bear trend, which is, I thought important to note. Bar one, a bull bar closing near its high, but a big tail on the bottom. Really not as good as it could be. We had a lot of bull bars into the close yesterday, so I think some traders might buy above looking for a second leg up, but we probably have to test the close of this big bear bar closing, with such a strong close yesterday, because traders who sold this close did a reasonable thing, and they should be able to scale in more even above the bar and get out at break even on their first entry. Doji bar on bar two, disappointing, I think, for the bulls who bought, but okay enough that what were you really expecting? I suppose if you bought above one, you basically wanted three on two. So I think it's hard to stay long. But you can see instead of getting a bear bar, we got a big bull bar on three. Now, after the big gap down, you have to be thinking that probably going to get a second leg down and probably going to get some sort of lower high, because the gap down just acts essentially as a big bear bar. So, pretend big bear bar from yesterday's close down to bar one, and we're probably going to get a lower high from that. Bar three, a big bull bar closing above the moving average, but a tail on the top, and the tail, sorry, I'm a little tired. Tail on the top, so not as strong as it could be, and following a doji bar, bar two. Bar four, a bear bar, but a big tail on the bottom. It's a low one short for the bears, but it's not really all that good. And bar five, a big tail on the bottom. So what do you notice? We went down on bar down on bar four, up on bar four, down on bar five, up on bar five. So it's one, pull back two, and then we're starting to rally. So it's a two-legged correction on a lower time frame, and bar three is a buy climax. So you can see we got a two-legged correction to the bottom of the buy climax, and that's where we bounced. Inside bar high one, bar six, but I'd rather not buy. It could be, it's not really exciting if you bought the close of three and you see four and five. So probably going to be traders looking to exit once we start getting up to that area. That's exactly what happens on seven. And, if you bought above six, not really loving your life with seven. So a lot of those traders are exiting around break even during eight. Nine, eight was a double top with four, and the neckline was the five low, but probably buyers below. It's hard to buy directly below eight since you're buying, relatively high in what's probably a forming trading range. So I think traders would look to buy a couple points below eight, maybe below the neckline, and that's exactly where they did buy. 10, a double top, but I think that we have so many doji bars and we're in a trading range. I would just wait for a strong bar in either direction. I thought, we were a little more bearish overall, considering the daily chart, where, like I mentioned, I think yesterday, if you had bought, the risk was getting pretty big, and these bars aren't all that great. So at a certain point, the bulls are going to dump out of their longs and decide they're not really as interested in being long. And that's pretty much what happened today. And it was, it just looks like a big low too at the moving average, and it is, but what really happened was the bulls who bought above here were hoping this surprise was really, really strong. And instead, it just ends up being a two-legged correction to the moving average. Granted, this is strong enough that it's probably the start of a trading range. So if we get back down to 5,000, which we very well might, I imagine there's going to be buyers. 11, a bear bar, but a big tail on the bottom. So again, I'd rather wait. It's a follow-through bar for 10, but I would just rather wait for even more follow-through. And you get more follow-through on 12. I think it's a good sell to close bar on 12. You're hoping that we're going to basically get a big follow-through bar that looks similar to 12 and close on its low, but instead you get a doji bar 13. It's technically bear follow-through, but it's really, I think difficult decision, right? Because you have a failed breakout below the low today, so it could be a trading range. And if it's a trading range, the pullback could be relatively deep, all the way up to maybe even the sell climax high, which is around the 11 high, 11 or 12 high, depending which one you want to look at. You can see that's pretty much where we pulled back to. So traders, some disappointed 13, exited, causing the bounce on 14. Others exit above 14, and that's what causes the rally on 15. So important not to buy above 15 because it was, 15 was caused by the remainder of the bears exiting. So now in order to buy here, you're going to need bulls to start to take over. It's probably not going to happen. So instead, you get disappointing follow through. 16, big tail on the top. 17, a bear bar closing kind of near its low, but again, a tail. So I think not quite as good as it could be, but it's essentially a head and shoulders top. The 1 high, the 8 high, and now the 16 high essentially formed a head and shoulders top. So you get a bear bar closing near its low. 17, maybe 40% chance we break out below the 11 low and go for a measured move down of the entire trading range, which is essentially what we did. 18, disappointing follow through with a big tail, and then more follow through for the bears on 19. So now you have 3 straight bear bars closing near their lows. It's okay to sell the close 19. There was something about 19 though that bothered me, and it was that you got to zoom in. It's pretty subtle, but 19 was not able to close below the low of the trading range. So you can see the 13 low was the low of the range. 19 traded below it and then bounced a little bit. So I thought that 19 not quite as bearish as it could be. And you can look at it and say, well, I think you're an idiot because look, you're saying it's not as bearish as it was, and look where it went. And that's fair, but I think that it just reduced the probability of something like this happening. So I thought it was better for me personally, at least, to wait until I saw 20. And 20, sell the close, okay to sell. Big tail on the top, big tail on the bottom. Follow through 21, okay to sell, but pretty big risk. Again, if you're selling, you're not selling expecting the next bar to look like 37. You're probably selling expecting the next bar to look like exactly what it did. And we're probably going to start to get some sort of pullback here. 22, a bull bar. Bears will probably exit above it. So what do some bears do? They sell the close of bar 22, trying not to let it trigger, so that traders will stay in the short, and that way they're getting good risk reward. One of the reasons traders don't want to sell below 21 is because the risk is really big. So once 22 forms and traders know they'll exit above, or other traders will exit above 22, they have no problem selling the close of 22 because they have a tight stop now and they're risking less. Obviously, the trade-off is your probability, but some traders do that. 23, a bear bar, but a tail on the bottom. It's a low one short for the bears. An inside bar 24. So we have an II 23, 24. Possible final flag. We try to get a breakout below at 25, but a big tail. Kind of a disappointing attempt at a breakout. And then 26, an inside bar, but this is pretty much the last gasp for the bears. If this is going to go, it needs to go now. And you do end up getting decent follow through on 27, but I'm not sure how much more downside we're going to get. The spike was really strong, so we might be starting the channel phase, but we might need to get a bit closer to the moving average. Bears have been selling the moving average all day. You can see during 8, 9, 10, they sold again on 16, so they might sell it again when we get there. Inside bar 28. Potential low one short, but really low in the range here. So traders exit or maybe buying back shorts below 28 and bulls buying below 28 more so than traders looking to sell. And disappointment 29. And that's what happens basically. 30 is, any trader who was short did not like 29. They knew 28 was a low probability trade and they wanted a good follow through on 29 and they didn't get it. So a lot of them exit, causing 30. 31, a bear bar, but a big tail on the bottom, and micro double bottom 32. I think the remainder of bears are going to exit above 32, and that'll cause the bounce on 33. Do you buy above 33? I wouldn't. I think it's just bears exiting, so not as good as it could be. And where are we going to rally to, right? Well, the moving average, yes, and I thought the 22 high was a reasonable target since that was the start of the channel. The start of the channel is always a target for trading range, the start of the channel is always a target. So when you have a spike and then a channel, at the top of the channel, you have to be expecting it to be a magnet. Disappointing follow through 32, 34, and then 35, big tail, micro double top 36. If you sell below 36, you can see we've tested here and we're testing the EMA. I don't know. I mean, it's probably theoretically okay. I marked it as a sell because it worked. I didn't mark it as a sell because it was something that I would take. But there was logic behind it because it's a big low too at the moving average as a trade. And a lower high double top, right? So lower high from here and a double top. And a micro double top. So I thought probably okay, but it's just not ideal. I think that selling 36, it's better to wait and see 37. And, a lot of times instead of 37 looking like this, it'll look something like this and you can sell that. I think it's hard to sell 37 because 21, 27, 37, potential wedge. And it's such a big bar. You're so far from the moving average that do you really think we're just going to collapse all the way down? It's pretty low probability of that. So probably exhaustion. Expect some profit taking soon. Inside bar 38, low one short, but not really that good. And follow through 39, big tail on the bottom. Inside bar 40, or sorry, not quite inside bar 40, triggered below the sell below 39, but not really all that great. But you can see we started to go sideways here. The low one on 38 was essentially the start of the channel, since we had the spike 37 and the channel started on the low one. Same way we had a spike over here and the channel started here. So the high of 38 is going to be a magnet, and that's what we were trying to test during 43. I think most traders who are short are just going to exit above 40. I'm not sure, I'm not really sure what's left for the bears to accomplish without a pullback to the moving average. I think it was on 43. So we test the high of 38 and get a reversal down. Probably buyers below, probably sellers above. And then inside bar 44. It's a bull bar 44, and we have 4 of the past 5 bars are bull bars. So probably buyers below 44, probably buyers below 40. Scaling in lower, expecting that we're probably going to get a bounce to the moving average. You can see that's exactly what happened during 45. Traders bought the low of the day. 46, you could argue lower low major trend reversal, but we might have to get a higher low. And then a pullback to the moving average, 47, 48. 47 wasn't even really ideal follow through. If you bought above 46, you probably wanted an even bigger and better bar, like a little bit of a bigger version of 33. And you needed consecutive bars. So you needed something relatively low probability if you're buying the lower low major trend reversal on 45, because you're buying the middle of a tight trading range, 38 to 46. So I think hard to do that. 48, potentially a wedge pullback. You see we had 3 attempts up, 38, 40, or the high of 38, the high of 43, and now we have the high of 48. And additionally, we obviously had the early open gap here, and then we had this open gap here at this point in the day, right? Because we can only see up to here. So I thought, probably okay to sell 48 and just take a chance, but you're selling in the middle of a tight trading range and really not as good as it could be, because I think it's similar to selling 36 in that a lot of times if you're selling below 48, if it's going to go, you're going to get a bar like 19 where you just get higher probability pretty quickly. So disappointment 49 as follow through, which is relatively expected. And then bull bar 50 closing near its high. 51 essentially outside down, and important that it touched it didn't quite touch the low. So this gap is still open. The 51 was able to close on its low, but instead we get a bull bar closing near its high, 52. 53 by the close, yes, but how much higher are we going? It's definitely always in long, and it was an okay swing by 52, and okay to add on 53. But that the 37 high is a sell climax high, and we're probably going here at the most. Additionally, this is pretty strong, so it might get a lower high in and of itself. So what are traders trying to do? I think they're trying to close the body gap. You can see we had the actual open gap here, and then we had that open gap here, but they're trying to keep the gap open on a line chart, meaning they don't want any close here above this point. And that's part of the reason why 54 existed. It's because traders were selling the close of 53 in a panic, trying to keep the body gap open, but it ends up closing on 55. However, 55, just looked like some sort of 3 pushes up, parabolic wedge. So instead of buying more, traders ended up selling the close of the bar, and we get 56. 57, a bear bar closing near its low. It's probably back to always in short, but I thought the reversal down was most likely going to be minor because of how strong the rally up to 55 was. 58, a bit of disappointment, and then a doji bar 59. I think it's an okay swing sell below 59, maybe after 4 straight bear bars, looking for a second leg down, but it's not ideal. It's just a bear bar, but I'd rather wait for a stronger bar like 63. And generally, when you see 60, a lot of traders exit on the close of 60. That's what's causing 61. So why are traders exiting on the close of 60? Well, because the spike was essentially 55, 56. Or basically just 55, and you could argue this is the channel, and we're trying to get a breakout below the trend line is a better way to put it. We're trying to get a breakout below this channel line, so we're trying to get a breakout below the channel line, which is already low probability. You're in the middle of a tight trading range now, right? So tight trading ranges are magnets, so when we broke down into it, we're in the middle of a tight trading range, and then potentially a second leg trap as well, 60. So this, and then second leg trap above. And so a lot of traders end up exiting, and that causes 61. But it's not really a great buy, 61, because 61 is caused by bears exiting. Disappointing follow through 62. You're not buying 61 either after 5 straight bear bars right on the moving average. It's okay to sell 63. Back to always in short. Better to sell 64. And traders are going to exit above 66. I would probably just be done on the day. You could argue 66, lower low major trend reversal. Maybe an okay swing buy, but probably sellers at the 62 low if we get there. Follow through 67, and then disappointment 68, 69. I think traders are going to exit below 69, and that's what causes 70, 71. Probably buyers below the 66 low. So hard to buy above 66 and get stopped out below 66 because there's more buyers than sellers below there. And then two legs sideways to up, and then we got the big sell off at the end of the day, which is relatively expected. Or not, so I wouldn't say relatively expected. I would say, it's a surprise, but had to be ready for a surprise coming into the day because it was the end of the month. Bear bar closing. So for stop orders, I thought 12 was fine. 19, 20, 21, probably 16. Maybe 26. It's just kind of a tough spot. If you sold 36, happy for you. Maybe you're better than I am. 52, maybe. 53, yeah, by the close, but upside probably limited. 57, sure. 64, sure. And I would probably be done. Maybe 66, but it's just kind of aggressive. For the weekly chart, big enough bull bar that there's probably buyers below, and we're at the moving average. So this might be just the second leg down. And think about it. If you had sold this close at 5,000 and then you saw this, how disappointed are you? Probably pretty disappointed. So even if we go outside down this week, I think there's buyers at 5,000. We might have to get back to 5,000. It's such a big magnet that, we're probably going to oscillate around it for a little while. I'd imagine we're going to end up bouncing somewhere up here, at least to the low of this bar, since bulls who bought the close or the low of this bar did a reasonable thing. So I'd imagine this is an area we're going to get back to, but we were probably going to oscillate around 5,000 for a little bit first. Close of the monthly chart, a decent enough bear bar. I think the big question for the bears is, are we going to get here to 48, to close this gap with, essentially the 2021 high, or you can see we failed right above it. But basically the open of 2022, this high, January 2022 high, 48.0825. Or was that, 2021. Are we going to get back to that? I'm not really sure. I could see this bar, just think about it. It's going to trade the same way a 5-minute chart would. So think about it. Maybe we'll get an inside bar this following month. But fresh month tomorrow. So, try and take good trades. I've honestly taken a couple. This is a personal tirade coming. So feel free to leave the video now. But, I've taken a couple of bad trades, this week, and I'm just annoyed with myself for it because, it's not, I miss a lot of good trades, but I try to just genuinely take, only the best trades, and that results in missing a lot of good trades, which is fine. But the problem, that really bothers me is when I take, bad trades, which is really the big problem with trading, right? Is learning to cut out the bad trades. But, I still had a reasonably decent month, but I'm just frustrated at myself because, it just definitely could have been better if I just take or just don't take a couple of those bad trades. So I personally think it's always worth it to miss out on good trades. If it means you're also missing out the bad trades. And it's really hard to do, especially for, first couple of years where, you're trying to sit out of bad trades and then you sit out a trade and it goes and it's just like really gut wrenching to watch because, you would have taken it. And then the next day you try to take that, same trade because yesterday you thought it was a bad trade, but then it worked, and then the next day, etc. But generally, I just think it's better to sit out of bad and good trades if it means you're only taking good trades versus trying to take all the good trades and you end up taking a slew of bad trades along with it. But anyways,